Good morning. We are set to begin our webinar. This is Connie Case with Reagan Companies, and we'd like to welcome you to our second webinar series for 2021. Today, we are going to be speaking about the COVID relief bill, the second round of the Paycheck Protection Plan, along with the employee retention credit. We will also take questions. If you have any questions during the presentation, on the navigation board, you'll see that there is a spot you can open up and insert your questions. We will go over that at the end of the webinar. The webinar will take about 45 minutes, and then at the end, we will address the questions that came in. With that, I'd like to introduce Bowers & Company. We have two presenters today. We have, both of them are CPAs with the firm. We have Rich Smith, who is a partner. His expertise in his area is multi-state tax consulting for large businesses, as well as 10 years with a Big Four firm. He joined Bowers & Company in 2020 and is a tax specialist in the Syracuse branch. We also have David, who, as well as a CPA, he joined Bowers & Company in 1992 and oversees the firm's tax compliance, technical research, planning, and consulting. And with that, I'm going to hand it over to you, Dave, to begin the presentation. And any questions come in, we'll address those at the end. Thank you.
Thank you, Connie, for the introduction. Good morning. My name is, Connie said, it's David Ayoub. I'm the partner in charge of the tax department here at Bowers, and as Connie said, I'm joined by one of my other tax partners, Rich Smith. Rich has recently joined the firm, but has plenty of experience. Not on the webinar today is someone that you probably know better than us, is Bob Tuska. He's also a partner with the firm, and he heads up our construction niche. We want to welcome you today to our presentation of the COVID relief legislation, more formally known as the Consolidated Appropriations Act of 2021. Now, this legislation is a mere 5,600 pages, but Rich assures me he's read every page. So this should go pretty well today. Since we've got an hour in total, only have an hour in total, we've had to narrow this legislation presentation down. We're going to talk about a few things, specifically the PPP program, which hopefully all of you are familiar with and took advantage of. And we're going to talk about some amendments to that original program that can affect you. The PPP 2, similar to PPP, but a second draw, which has some more strings to it that we'll go through with you. We're going to talk also about employer retention credits. Now, if you might be familiar with that term because it was in the CARES Act. However, it was not as useful as they thought it would be, so they made some changes that affect the 2020 year, as well as enhancing it for the 2021 quarters 1 and quarters 2 so far. We'll also talk about some of the business and individual provisions in this legislation. And if we have time, we'll take a peek into President-elect Biden and what he is proposing during his term. As Connie said, if you have questions, please get them in. And with that, I'm going to bring Rich into the conversation to start things off. The PowerPoint presentation will be posted to our website after the presentation. Rich?
Thanks, Dave. So as Dave mentioned, this entire bill, the 5,600 pages, which he assures you that I read, and I can say I read most of it. I may have skimmed a little bit, but nonetheless, here we are. The entire bill here is called the Consolidated Appropriations Act, and I just have this slide just to mention that within that act are other acts references. So, for example, we have the COVID-related Tax Relief Act of 2020, the Economic Aid to Hard-Hit Small Businesses, Nonprofits and Venues Act, the Taxpayer Certainty and Disaster Tax Relief Act. Within all those acts are various things that we're going to talk about today, the PPP, the ERC, some of these miscellaneous provisions. So I only mention that if you hear people referring to the COVID-related tax relief act, that is within this CAA. So the first thing we're going to cover is, as Dave mentioned, one of the big ones, which I'm sure is on everybody's mind, is the PPP. Just a quick refresher. I'm sure we're all familiar with the CARES Act and what was passed back in March, but just a refresher of where we started with this PP. It was initially $349 billion in funding, which, as you know, went out pretty quickly. So they added another $310 billion. These were 100% federally guaranteed. There was no collateral, no guarantees. You did not need to prove you could not get credit anywhere else. You were maxed at the lesser of 10 million, 2.5 times payroll. We had eligible uses of the loan proceeds for forgiveness, payroll costs, health benefits, so on and so forth. There's been a little change to that, which we'll cover later.
Right.
And then 60% of that had to be used for payroll, and you had covered periods spanning from 8 to 24 weeks.
Right. And really, the big thing with the initial program was what they were trying to do is obviously have you keep your employees. So headcount was a very big piece of the first PPP program.
Correct. Yeah. If you had a reduction in headcount or a reduction in wage of 25% or more for people making under $100,000, you had an issue with potential issue with your forgiveness.
So yeah, so you could always get the loan based on the numbers of wages and things, but it was really about keeping the people on the payroll to get it forgiven, and that's the goal.
Correct. So that's just a little refresher of where we started with all of this. So the first slide I'm going to cover here that was part of the CAA, and there's actually a revenue ruling by the IRS 2021-02, but our PPP loan expenses. I'm sure that you've all seen there was a lot of discussion, a lot of articles, a lot of commentary. When this first came out, your loan was forgiven. It was a non-taxable event to you, and then the IRS came out separately and decided that because of the way the tax law was written, that if you use those forgiven proceeds on certain expenses, those expenses were now disallowed. So that, in effect, made your loan taxable. They got a lot of heat for that within Congress and a bunch of organizations. So this CAA has changed that. The IRS has also issued a revenue ruling. So now this is a non-taxable event to you. If you have a PPP loan, it's forgiven. That's not taxable, and your expenses are deductible. So it should be a non-taxable event. In addition to that, they actually even clarified a couple other things. They clarified that forgiveness is tax-exempt income under the code, and that it will increase your basis. So for your S corp, your partnerships, it is not income, but it increases your basis, which potentially increases your ability to take distributions or take deductions.
So in reality, then, if I got one of these PPP loans, I paid my payroll, but I didn't really have that bad of a time of it. This money essentially becomes tax-free that can come out of the company.
Correct.
I mean, that wasn't the goal, but the goal was to keep the company running. But if you did that with the way they've given these provisions to increase our basis, that money can come out tax-free. So now, talking about S corps and partnerships, that goes right to the owner's pocket. Pretty interesting. Correct.
Yeah, not the intent, but certainly a result that has come out of it. New York State, there was some question as to how this forgiveness would be treated in New York. They decoupled from the CARES Act, but the manner in which they did it, they would have needed to amend their code. They've come out recently and said through some FAQs that they are not going to tax this. They're going to follow the federal treatment, so you should not pay tax on it in New York either. So.
Yeah, I think that's a great update by New York, and timely too.
The other part of this, as we were talking about here, you could just, to be aware, there's some potential timing issues because the expenses that you've paid with your loan, those are deductible when you've incurred them or paid them, which in most cases with round one was going to be 2020. Your tax-exempt income, that when you recognize that, when your forgiveness happens, that could be different. If you haven't applied for forgiveness yet and you're in 2021, you're not going to have that forgiveness event and that taxable income in 2020 to match up with those expenses. So taking Dave's situation and flipping it the other way, if you did get a loan and you used it on the right expenses, you were able to deduct them, and you had a bad year and you had some losses, and you needed basis to take those losses, you may not get the basis from that PPP loan until the following year. So you may have losses that just get hung up for a year. So
that's very true. The flip side of that, though, is kind of more to my example where I didn't, I had a bad year, but maybe not so bad. I took all these deductions with the money that was given to me, and I've got a loss. I've got a big loss even. Part of the CARES Act, which we're not talking about today, but they provided a 5-year carryback. So by making these expenses deductible for tax purposes, you now have the potential ability to have a big loss, and if it's a net loss, you can carry that back up to 5 years.
correct.
So that could be a real big item for you here. But if you don't have basis, that's again just another item to consider, and whether I have losses that I can actually carry back. So.
Yep. Nope. Both important points. So moving on. So again, these eligible expenses, what we're covering here is the same right now under the CAA as it was under the old program. So when we're talking about we've gotten our loan and we're looking at forgiveness, eligible expenses are, your payroll costs, which I'm sure we're all familiar with, our wages. Under 100,000, you have a cap of that annualization of 100,000 per employee. Mm-hmm. If you've used wages for any other types of tax credits, those are not going to be eligible to be part of your forgiven wages. You can't use them for both.
Right. We're going to talk about that in a little bit with the employer retention credit.
Correct. And then just a couple other things. I think we're probably all familiar with this now, but just a reminder here that it's not just the wages. If there's health insurance, dental, vision,
yep.
Life, disability plans that the company's paying, retirement benefits that the company's paid, and then employer level state taxes such as your unemployment, those all count as payroll costs. So it's not just that wage piece. It's important to remember that those count and to make sure you're grabbing those when you're looking at that, trying to get to that 60%.
And I guess the one thing I want to add here, Rich, is in talking about the full-time equivalents in terms of these eligible expenses. If for some reason you can't hire back, if you had to let people go and you can't hire them back, well, that's going to affect what kind of forgiveness we can get on that loan. But they did put in a couple of caveats that if you couldn't get the people back, you might not have this reduction in FTEs causing you to not get 100% forgiveness. And they mentioned orders by the CDC, yep. or OSHA,
yep.
where you just, again, there are more detail behind these, but suffice to say, don't feel like, well, these things happened to me that were beyond my control, and now I got this loan, I used it properly, but now I'm going to have to pay it back because I can't get forgiveness because I don't have enough people
right.
still working.
Right, and if you've tried to hire people back and they refuse to come back, that's also an exemption.
And I had a client in the restaurant business. They actually sent letters to these people to verify, that they couldn't get them back.
Yeah.
They just would not come back to work. That's back when they were getting $600 a week unemployment on top of their unemployment. Right.
And that's important because if you've made those attempts to get that head count back and now it's back, you have till 12/31/20, but right. If you had a reduction in headcount from where you were in February, and you've made an attempt, like Dave is saying, if you made an attempt either trying to rehiring or you're not able to because the CDC just won't let you bring them back for whatever reason,
right.
Those are exemptions to that headcount reduction. So don't feel like if you haven't been able to get the headcount back, you're stuck.
Right.
Moving on through our eligible expenses, this is the 40% bucket, the non-payroll costs. So rent or lease payments for any rent or leases you've had in place prior to February, mortgage interest, interest on certain debt, mortgage interest or interest on certain debt in place before February 2020, utilities. Those are all the same that you had during the original program back in March. There are 4 new categories that came out as part of the CAA, and these are important because they're retroactive. So if you had these back in March, they're going to count both for this new round of funding, but also the old round of funding. And I'll just go through these. So, and a lot of these are I'll call them COVID specific, but that's kind of what they are. But covered operation costs. So, many of you may have had employees, we've got to work from home. We've got to put in new software. We've got cloud applications. We've got an expense we've incurred now. That's now an eligible expense. If you had any type of property damage from, I don't know, rioting, vandalism, whatever, and it's not covered by insurance, that's an eligible expense. Covered supplier costs. These are supplies, normal supplies you would buy to run your business. Now, the rub with that is it has to be pursuant to a contract or some type of purchase order that was in place before you got your loan. But to the extent you had that, you have a contract in place and you're buying supplies essential to your business, those are now eligible expenses. This last one is basically PPE, covered worker production costs. Things you had to buy for your employees so that they could come to work, or modifications you had to make to your workspace, your manufacturing facility, your job site, whatever those are, so people could operate under these health orders. That's now an eligible expense.
Like some of the plexiglass we got out here, Rich, in our lobby and things like that?
Yep, exactly. Those are eligible expenses. And these are important because if you haven't filed your application and you're going through it and you're saying, the heck with it, I've got, I'm going to put 80% of this as payroll because I've got enough payroll, and I'm not going to spend a lot of time with these other costs because, whatever. You can now go back and look at some of these new costs and see if maybe it makes sense to include those to reduce the amount of payroll you need to use. And where that'll be important is when Dave talks about the employee retention credit, because you may free up some wages that now you might get a credit against.
Right.
So,
if you were too anxious, I'll say, and wanted to get that debt relief, you may have already filed and just said, hey, I got plenty of payroll. I don't have to dig into these other expenses, and that's what you put down in your forgiveness. I think the question is it too late to change that? Or if I could potentially qualify for these credits we'll talk about,
yep.
Or am I locked in? Did I rush too quickly?
Yep.
So that'll be something we'll talk about in just a little bit.
Yep. So moving on now though to our second round of funding, our second draw loans here. I'm going to go through our eligibility on these. So some new requirements, a little different than the first round. You have to apply before March 31st. You had to have been in operation before February 15th, 2020. One thing I don't have on here that's important, and I realized I did not have a bullet on it, but you also will have had to have used your initial round of funding or will use it. You certify that you will use it before you get this next round of funding. So if you have gotten a first round of funding and for whatever reason you haven't spent it all yet, and you don't think you're going to, you may not be eligible for this second draw loan. You have to have spent it or certify that you will before you get that next round of funding. Moving on, they put some employee restrictions, 300 or fewer employees. The big one here is this next one. You have to have experienced a 25% decline in gross receipts during any quarter in 2020 compared to that same quarter in 2019. So for example, you have to look at, let's say you look at Q2 in 2020, compare it to Q2 19. If you didn't have a 25% reduction and you do that for each quarter, you're not going to be eligible for this second round of funding. You have to hit that 25% requirement.
So Rich, I just got to meet the 25% decline in any quarter, just one quarter, and I'm qualified for the loan for the whole year.
Yes. Yep. And you can also, they had something in there where someone says, well, geez, I don't have my quarterly stuff. I can't pull it together for whatever reason for 2020. If you look at your total year for 2020, and you have a 25% decline to your total year of 19, you also qualify because, mathematically it would be tough to have a full year 25% decline and not have at least a quarter where it is.
I would agree.
So that's a big one. You got to hit that. Otherwise, you're not going to be eligible for this second round of funding. Gross receipts. It's interesting with this one. So, how they've sort of defined this in some of the initial things that have come out is all revenue in whatever form received or accrued in accordance with the entity's accounting method. And then it goes, goes on to say here, from whatever source, so your normal sales, interest, dividends, rents. Your PPP loan forgiveness is not part of that. So even though from a book perspective that may be income if it's forgiven, you're not required to include that as income. What's interesting here is they further go on and say that their expectation is more or less this would be receipts that you would expect to see on your 2020 tax return when you're looking at this, which, that could be a different number than what you have in your financials, especially for a contractor who's using percentage of completion for their financial statement accounting, and they may be on a different method, completed contract. They may be an all cash basis taxpayer for tax return purposes, where those receipts may be totally different. And we haven't seen obviously any guidance to say, how you apply that analysis when you're going to fill out your application. So, we'll have to see, but it certainly seems like they're gearing more towards the tax return and what you would expect to see on there.
So not to get too technical here, but just to throw out an idea, with tax returns, we have the ability to change methods of accounting, and especially with contractors. I mean, there's multiple methods, and so if we were potentially to change our method of accounting, that could affect 2020.
For sure. Yep.
I mean, that's a possibility, correct?
It is, yeah, and that's where you may have been percentage of completion for tax for 19 and completed contract. Aside from being a better tax answer, may show a decline in gross receipts to get you under the 25%. Is
right.
that is that allowed? I don't know. They haven't said for sure, but
is that allowed? And on top of maybe be able to get us a loan, would it reduce our taxable income for the year?
Exactly.
How about that?
Yep.
Double whammy.
So that's, the 25% piece is big, and then, kind of digging into this gross receipts is important. The last one I'll mention is the affiliation test. This is not new from the standpoint of the test existed. If you might recall that it was out there with the first one, where if you had, they started with 50% or more voting control. So if you own several different entities, or there was some related ownership and it was 50% or more of the voting, you had to look at all those entities when you were looking at your employee test to see if you were under the number of employees to be a small business. And that's a broad test. They start with that 50%, but they also go on to say, they have other examples, and it's basically wherever there's entities that are kind of affiliated and can be controlled by the same group, the board or CFO, if they have the ability to control the vote of those related entities, chances are you might fall under this affiliation test. And, it's important from the employee standpoint test, but they've also expanded it. So now this gross receipts test we've just talked about, having to meet that 25% reduction. If you've got entities that fall under this affiliation test, you've got to aggregate all their receipts. You've got to meet it now for the total group. You got to look at it for everybody.
Right. And before, well, like Rich says, it applied in the first round, but the employee level was 500. So I don't think really you weren't probably in a lot of cases weren't worried about it. But now the same test, you only got 300 employees. So it's more of an issue, and you had the gross receipts test. This affiliation test, this is out of the SBA regulations. This is not from the tax law. This is their affiliation test. So it's a little bit more, I hate to use the word common sense, but it is when you look at these, there's 4 or 5 different affiliation tests in there, and they're really probing to see, is there control? Is there enough commonality that we should be combining these entities for these 2 tests?
Yep, and the control is the big piece there. Second, real quickly here, who's not eligible? If you're a publicly traded company, I'm going to skip permanently closed for a second. Entities affiliated with China, and then entities with any type of government affiliations, those are not going to be eligible.
So like President Trump, Vice President Pence, all of Congress, all exempt.
Not eligible.
Not eligible.
Not eligible.
If they're more than 20% owners.
Yes.
More than 20% owners. So
permanently closed. If you're permanently closed, you're not eligible. I find this one a little bit interesting only because they don't really define permanently closed. So I think of like a restaurant who's, maybe they've said it's not worth opening because I can't make money at reduced capacity, so I'm closed. Well, what if getting this loan allowed me to reopen and be back operating? Like, how do I tell someone I'm permanently closed? Do I post it on Facebook? I mean, what does permanently closed mean? Do I have to have liquid? So I haven't seen any further guidance on that, but I just find that interesting and how you prove you're permanently closed.
I think that one, Rich, we've got a lot of latitude in that unless you sold the equipment and terminated the lease,
Yeah.
I don't know why you'd be permanently closed.
I agree. So that's an interesting one. Our loan amount, second round, a little bit different. Our maximum loan amount is now capped at $2 million. So still got the payroll, right? We still got our 2.5 times our average monthly payroll, but now instead of being able to get up to $10 million, we're capped at $2 million. One change here, and this is geared towards our service industry, restaurants, hotels, things of those nature. If you have a NAICS code of 72, you're going to be able to use 3.5 times instead of 2.5 times. So get you a little bit more, potentially a little bit more loan there. And obviously that's geared towards helping out some of our restaurants and hospitality industry that's been kind of hit pretty hard by this. Seasonal business, when you're looking at this for your average of your payroll, you can look at any 12 weeks between February 19th and February of 20. Obviously, they're recognizing there that your payroll amounts that you might use for this loan could vary based on your hiring or based on your business. So you have the option there to use any 12 weeks. And then I just have a note here on our loans less than $150,000 on this second round. What they have said on the initial application, you do not, there's a simplified application, you do not have to provide the revenue loss on your 25% gross receipt loss on this on the initial application, but they're going to ask you for it later. So how simplified is it? I mean, I guess if you're, you need the money right away and you're going to be under 150 and you're going to meet that 25% test, you can do the application. It's simpler. You don't have to put the document in there now, but you're going to have to do it sooner or later. So it's simplified from that standpoint, but you still are going to have to prove that 25% reduction.
Yeah, and one of the things we don't have on the slides here, I just want to bring up and discuss with Rich a little bit, is this what they call the necessity test.
Right.
Okay, we had it in the first loan program, the regular PPP, and basically what it is, it's an analysis to say, do I need this loan? And I think where we sit today versus where we sat back in March of 2020 are probably two different two different times in the sense of economic activity and certainty and uncertainty. And so this necessity analysis is something, again, in the SBA rules that talks about, your ability to access liquidity, unrestricted cash reserves, where your locations are, what the state plans are. Is your state open? Is your state closed? Employee attrition, replacement, training costs. There's nothing hard and fast here, but it's something that if we didn't bring up to you and you didn't take a look at, I think you're missing the boat a little bit. Just to be, to look at this and say, do I need this? And some people might, an outsider could look at your business and say, oh no, you're very healthy. But are you really? And you really have to ask yourself that question. Back in March of 2020, when the pandemic was beginning, I don't know if there was anything certain. And I think at that point, like happened, almost 600 billion, maybe 500 billion of the total went out. There was necessity. Is there now? Well, to get this loan, you got to have a 25% gross receipts reduction in 2020. So let me ask you this from a business standpoint. You go down 25% in gross receipts in your business. Are you going to pop right back? Especially in the construction business, contractors and things. I don't know. I'm throwing it out there for food for thought. But to me, revenues don't grow on trees for most businesses. And I think if you've had that reduction and you're eligible for this loan, going through some of these questions to, get a good feel for where do you stand and meeting this necessity test. I think it's just something that, you should think about.
Yeah, I agree. I mean, the 25% is obviously black and white, and you meet that, it seems like you qualify, and I would argue you do. Just as Dave mentioned, that same certification you had to make with the first one that you need the loan is there for the second one, and if you bounce back a little bit and now you're doing well, if you're using an earlier quarter to get to your 25% and now you're kind of doing well, not saying don't take the loan, but just give it some thought.
Yeah, put some thoughts down on paper of issues, going through this necessity test to see, where those question marks are, where those pitfalls potentially are. And when you do that contemporaneously today, and if you're ever challenged, a year from now, you've got some things you thought of.
Yep. So moving on to, I call this PPP Round 2 first draw loans, but these are not much different than the CARES Act, the loans under the old PPP loan program, I would say. So these we're calling them first draw loans. So this is eligible to companies that you didn't take anything during that time back in March, April, May there with the first round of funding. You didn't do a PPP loan. Now you think you might want one. So you're under kind of the old rules. The maximum loan amount, $10 million. You still got that cap on the payroll, 2.5 times payroll, all that. All those rules still apply. Fewer than 500 employees, not eligible if you're filing bankruptcy. If you had taken a loan but returned it, or you haven't applied for forgiveness and now you think you might be eligible for more than you took, you can reapply. And you'd be reapplying under this first draw loan. You'd be reapplying with that $10 million cap. So, again, it's not that round 2, it's not that receipts test. You're still under this first draw loan, and you're kind of under those old rules.
So if I got bad advice, back 7, 8, 9 months ago,
right,
and even if I applied for a loan, but all I used was my payroll, and I used, I just grabbed the number and it was wrong. It was way understated. I didn't include any of my employer-paid health insurance. I didn't include any of my retirement payments.
Yep.
I'm going to go back and redo that loan. So if I got $100,000, now I can get $800,000. That's still under the first program.
That's still under the first draw. Yep.
So then, even if I get that, maybe I'm jumping ahead a little bit, but I'd still be eligible for round 2, wouldn't I?
Yes.
Okay.
But you remember for round 2, you have to have spent or will spend all of the first round funding. Okay. So just to be clear, if I go back and get more money or get a loan under the first draw, yep,
okay, and I've already paid payroll, but I didn't have the money, so I used my own money, so to speak. Now I get this additional funding. I have to spend that going forward, or can I say I spent it on expenses in the past? I probably got to spend it going forward, and I have to spend any new money going forward. So that's a lot of payroll. It is. Yep. And that's, again, you can't even get to the second round until you've spent that first round. So you've got to get that money, have spent it, certify that you'll spend it. So my understanding is there's a lot of small businesses that didn't apply in the first round, whether they're underbanked and didn't have proper financial guidance or whatever. So this is really a kind of an olive branch to those people in those businesses to
exactly
get them the loans.
Yep, and they kept that cap up higher too, so you're not stuck with that $2 million if you were bumping up against it.
Beautiful.
Just some other information quickly on the PPP. Again, covered period. This is under the CAA, but there's some similar stuff. Hasn't changed much from the original. 8 to 24 week cover period that you're going to select that period. If you need more time to spend the expenses, you're going to kind of stretch it out. Loans under 150. Again, I mentioned that there's a simplified loan application, but there's also a forgiveness application for those that is simplified. If you had gotten an EDL advance, that was that $10,000 advance prior, that you would reduce your loan forgiveness amount by that. You no longer have to do that, and that is also tax exempt. And what Dave's going to cover here shortly, this employee retention credit, prior law, if you took a PPP, you were not eligible to claim that credit. That's gone. and that's retroactive. So going back all the way to March, if you are eligible for the ERTC and you took a loan, you can now take that credit. Before you couldn't. A couple quick things here. If your first loan app, you used your calendar year 19 payroll and you're going to use your same lender, the SBA is saying you don't have to resubmit that supporting documentation for payroll. Now, I will tell you, I've heard of at least 1 or 2 banks who are still asking for that. So that may be more of a lender checks and balance versus an SBA thing. But according to the SBA, you don't have to provide that if you're using the same lender. And then if for whatever reason your loan's under audit, your initial loan, it's under audit, it's being additionally reviewed by the SBA, and you would have gotten notification of this, so you would know. You're not allowed to get a second draw until that's been cleared up.
Oh, okay. All right. So I guess for sake of time, because we've only got so much of it today, and this is a 5,600-page piece of legislation, let's talk about the employer retention credit. And the quick refresher here is that this is the best kind of tax credit. It's refundable. You don't have to have income to offset with it. It's a 50% credit on qualified wages from last March to the end of 2020. However, it was only on $10,000 per employee for the 2020 quarters. Okay, so that's $5,000 per employee if they're paid at least $10,000. That's nothing to sneeze at. It had a little bit of an oddity here in that if you had more than 100 FTEs during 2019, qualified wages were only wages paid to an employee who was not working. If you were under 100, anything you paid to a worker, working or not, qualified for the credit. So a little bit odd,
Yep.
but that's behind us in that respect. To be eligible, this was a pretty stringent test. You either had to be fully or partially shut down due to government orders, and there was a number of government orders, or very big you had significant decline in receipts, 50% when you're comparing 20 to 19 quarters. Okay, that's on a quarter-over-quarter basis. But if you qualified in a quarter, let's say you qualified in quarter 2, you were able to take the wages. Potential wages for the credit in quarter 3, unless you came back up above 80% of gross receipts. But even then, you got it in the 3rd quarter. You were out for the 4th quarter.
Correct.
So it was it's kind of an odd credit. And as we've talked about a few times, if you receive funding under PPP, you were originally ineligible to claim this credit.
Yep.
Okay.
And on that shutdown, it's a little bit, obviously not black and white. We kind of know what the orders are, but, I've had some contractors call me and say, well, yeah, I was shut down on 6 of my 10 jobs because of restrictions, but I took all the guys that were going to work there. I shifted them over here. He's like, I wasn't working at full capacity because of it, but I had guys working to keep them employed. Does that fall under the shutdown? I mean, potentially,
yeah.
Sounds like a partial shutdown, but
it does.
Haven't seen a ton of guidance on that, but that's just something to keep in mind.
Okay, so now the employer retention credit for 2021, the first 2 quarters, this credit is available with a couple of interesting changes. The biggest one being that anyone with a PPP loan is now eligible to claim the ERC retroactive back to March of 2020. There's some complexities with the ordering rules on whether we take wages for ERC first or for PPP first, and we'll talk a little bit about that. But just to show you some of the changes in the credit itself, now it's $10,000 of wages per employee per quarter, okay? Not per the year. So the 1st quarter, 2nd quarter, if someone makes enough money, you can take the credit for this employee up to $10,000 in the 1st quarter, up to $10,000 in the 2nd quarter. And the rate has also been increased from 50% to 70%. So effectively, that's instead of a $5,000 credit for a year on an employee, that's $7,000 per quarter.
Yep.
Significant change.
Yep.
Okay. The other thing that again makes this somewhat more usable is that you've only got to have a 20% reduction in gross receipts. Now, all you business owners are probably saying, only 20%, huh? Well, that's significant. I agree, but it's not 50%, where at that point, you're struggling to keep the doors open probably. So again, a little bit more taxpayer friendly. The threshold in terms of number of employees has been raised to 500 from 100. And this is an interesting one. I had to talk about this with Rich, is that, so if in the fourth quarter of 2020, I meet the 20% reduction over 2019's fourth quarter, I get the credit. I'm eligible in the first quarter of 2021?
Of 2021, yes. They put a safe harbor in for that first quarter of 2021 where you don't need to compare Q1 2021 to Q1 19. You can use Q4 2020. And really the reason for that is most people, I say most people, I shouldn't say that, but their thought process was Q1 2019, the pandemic hadn't really hit, and then Q1 of 2021, maybe people are starting to rebound or businesses are starting to have open back up, have more receipts. So when you try to do that test, you might not meet it, and they want to make this credit usable. So what they've said is, why don't you go back to Q4 2020 and you're able to use that, compare that to Q4 in 2019, which may get you in under the test.
Great, yeah. Again, being very taxpayer friendly here. As we mentioned, the payroll costs eligible for the PPP loan forgiveness are not eligible to be counted again as wages for ERC, but that leads us, to an issue we'll discuss here. But just finishing up with some of the other changes, like most tax credits, if we're using wages to calculate a credit, we can't also deduct those against our taxable income. So that there's a little bit of a negative there. But again, a dollar worth of credit is worth more than a dollar of deduction every day, all day. So the question is, what about New York State? Did New York State include that in the FAQ that they're allowing this as a deduction?
Well, there's no comparable credit
right.
for the payroll taxes. So if you deduct, or if you have to add back wages because you're taking a federal credit, you'll be able to deduct those for New York because you don't have a comparable credit from a state perspective.
Right. That's generally how they'll do it. They have specific ones outlined. So in other words, if in quarter one I get a $7,000 credit because I qualify and I've got employee wages at $10,000, I get a $7,000 federal tax credit. I add back $7,000 to my taxable income for the year.
Yep.
For federal purposes.
Right.
I get to New York, I subtract that $7,000 out because I didn't get a credit in New York.
Yep.
Okay.
Yeah, we'll need to. They have not issued an FAQ specifically on that, but generally speaking, that is how they treat them.
I would agree with that. And the last bullet is really, kind of the issue here. There are some rules about technically wages are supposed to go against the employer retention credit first. And again, not clear, even if you don't qualify for the credit. Okay? So therefore, I have less wages for PPP.
Right.
Well, that's not good. So what they did was they've included an election which you can elect to apply your wages against PPP first for the forgiveness. Now, I made that sound easy, but it's not that easy. There's some complications and kind of lack of guidance to it is really what it is. A couple of the other things are, since this is a payroll tax credit, okay, based on our wages, are we going to be filing amended returns? Because payrolls, we have quarterly filings, as everyone knows. If we figure things out and get the guidance, can we file it all as part of our fourth quarter, which is due at the end of January, given today's the 19th, and what we have? I'm kind of doubting that, but that's still a possibility. So while this particular credit is an excellent credit, and they've made some great changes to it, there can be some complexity here. And let me just summarize: if you got a PPP loan and you had a significant reduction because of a partial or if we're fully or partially shut down because of a government order, or had a 50% reduction in gross receipts during a quarter in 2020, be very, very methodical and purposeful when you're calculating wages to be used for the PPP. Because if we don't use wages for our PPP forgiveness, they are available for this ERC. So if we meet those criteria and to be eligible for it, you need to scrutinize exactly what you're using for wages in the PPP. And, you know, you might be at the point where, well, if I only use 60%, which is the minimum amount of wages for PPP loan forgiveness, I don't have enough of the others. Well, what I'm going to tell you probably is use more wages, get your dollar of debt forgiveness, okay, and we'll move on after that.
Yep, agreed. And that's why, you know, tying this back to the PPP and some of those new eligible expenses that I called COVID related, if you haven't filed for forgiveness, again, that's a good thing. If you think you might fall under this ERC or be eligible for that, go back and scrub that. Maybe there's some expenses in there that you can pull in and drop down the amount you're using for payroll. That'll free up some payroll for the ERC. So these two kind of work together a little bit. And like Dave mentioned, it's important. You know, I know a lot of people, and I've talked to some of my clients who are they're ready to be done with it. They're ready to file for forgiveness, get it off the books, move on.
Yeah.
You know, and I completely understand that, but I would just encourage you, if you think you might be under the, able to claim the ERC and you're using more than 60% of your payroll on that forgiveness app, to just, you know, spend a little time and revisit that.
Right. Slow down. And what the real difficulty here is not, you know, I can tell my gross receipts if I've met that. The subjective areas are going to be those shutdowns, partial or fully. And then getting the actual wages you need per employee per quarter. Sounds easy, but we've been working with the payroll companies and they're not hearing us.
Yep.
So you may have to manipulate the data a little bit in terms of the payroll reports that we can get. Rich?
Yep. So I know we're running up on time, so I'm going to go through these next couple quick so we can deal with some questions if they've come in. So there were, PPP and ERCs getting some publicity, but there were other provisions that came through that were in part of these acts. So I'm just going to cover these really quickly here. So business provisions, we've already talked about the PPP loan being non-taxable. Same thing for the EIDL grants or SBA loans where the SBA was making principal and interest payments. Those are non-deductible, those are not includable in gross income. Business meals for 2021 and 22 provided by a restaurant are non-deductible. They haven't really clarified what provided by a restaurant means, but
that's my favorite one.
So yeah, so that's obviously in an effort to get people eating out and then allowing the business deduction. 179D, that's a deduction. It's based on, a certain amount per square foot, but it's energy efficient improvements to commercial buildings. That was always kind of extended. That's made permanent. You can reduce reduce for 163J is really what this was, business interest limitation. Used to be, if you elected out of that, you have a 40-year life. It's 30 years, so you'll get the depreciation quicker. Railroad track maintenance credit, this is another one that was always kind of extended. This was made permanent. They did reduce the rate from 50 to 40% starting in 2023. Work opportunity credit was extended. The employer credit for paid family and medical leave was extended through 2025. And then the Families First credit, that was you may be familiar with, was a mandate to pay employees if they were out with COVID or their family member was out with COVID. And that was mandatory. That expired. The mandatory piece of that expired in December. However, if you choose to continue to pay under that program, the credit that was eligible that you could get for that under that program, you can do that through March of 2021. So it's not mandatory. You don't have to do it. If you choose to continue to do it, that credit is still there at least through March. Individual, very quickly, we've all seen the stimulus payments. Those come through. Those the 600 plus the 600 times qualifying children, 1,200 married filing joint. They've increased, if you don't itemize and you do charitables, they've increased that deduction to 600. There's no AGI limitation on your charitable contributions for 2020 and 2021. The gross income limitation for medical expenses is staying at 7.5%. Tuition deductions repealed. They did increase the phase outs on the education credits so that the two of them are equal. PPP, if you had to buy that, it's a qualified educator expense. Mortgage insurance premium continues through 2021, and then The 10% penalty from retirement plan distributions, if you're in a qualified disaster area, and it has to be a qualified disaster area, and you make a distribution under 100 grand before June, that penalty does not apply.
So, you know, Rich, at this point, since we ran a little bit long, Connie, do you want to go to some questions now, or finish up with the Biden proposal?
Let's finish up with the Biden. We got a couple of questions that came in, so I think we're doing okay.
Great.
Okay. So
Thank you.
I'll cover, sure. So the Biden proposal, you know, he floated this out there. Haven't obviously seen a ton of details because it's not passed, it's not legislation, and there's really no incentive for him to provide details at this point. But here's some of the things that we do know that are in it. So he is proposing to increase those stimulus, those advanced credit payments to $1,400 per person. He's proposing to increase the federal unemployment aid from $300 to $400 a week and extend that out through September. It's currently going to end in March. He would extend the eviction moratorium to September 30th as well. He would increase the child tax credit pretty significantly, $3,600 for children under age 6 and $3 grand for children 6 to 17. It's a temporary increase in his proposal. He would raise the earned income tax credit, and he would increase the income limit so more people are eligible. Reinstate the paid sick and family leave benefits that expired at the end of the year that we talked about not too long ago. He would extend those through the 30th. Interesting in there is that he had something, and obviously we don't have any details on this, but there was a note in there that the government would reimburse employers with fewer than 500 workers for the full cost of providing that leave. You know, obviously, again, no details on that, but that was in there. He would propose to increase the minimum wage to $15 an hour. He's proposed an additional $15 billion for new grants for small business owners, $350 billion to state, local, and territorial governments to keep frontline workers employed, distribute vaccine, increase testing, reopen schools, maintain vital services. Again, you know, no explanation of what falls under those categories. There's also some additional funding in there for states, and no real detail on, you know, how that's to be spent, where that's to go. So, you know, I have a note here. We have a note. Devil will be in the details as always. I mean,
as always,
as the legislation we kind of worked through today was 5,600 pages. There's a lot in there. There's a lot of little nooks and crannies in there that, you know, you really got to spend some time with. To make sure you're not missing anything. And even with that, you know, as we mentioned a couple of times, there's some further guidance needed. So, you know, even with 5,600 pages, there's still some unknowns. So we'll see what happens with the Biden stuff, but those are some of the things he's floated out there.
Okay.
So, yeah, Connie, I think you mentioned a couple of questions. I think if you're ready for the questions, we can take those.
Yes, thank you very much. One of the questions that came in said, does the 8 to 24 weeks start with the date received funds, or can we choose the date to start and within the 8 to 24 weeks?
So the 8 to 24 weeks is called your covered period, and that is when you receive your funds. So the day you get your funds starts your clock on whether you're going to pick either some number between 8 and 24. So it's when you receive your funds is when you start.
So that one's cast in stone. The start date is cast in stone. The end date, though, is up to you, correct?
Correct.
Right. So if you couldn't use all your funds in 8 weeks, but you could in 16, that's when you can cut off.
Yep, exactly.
Right.
Okay, and the next is with the families first. If we do want to offer it voluntarily, how does that work if we apply for a PPP loan with the tax credits on the families first?
Yeah, in terms of the wages, those may, I'd have to check those. I don't know if you would be able to take wages that you're receiving a tax credit on and count those towards forgiveness.
Yeah, generally
you're not going to be able to double dip. So my expectation would be it's going to work similar to the ERC in that if I'm using wages to generate a tax credit, those are not also going to be expenses I can count towards forgiveness. You know, and I failed to mention on the Families First thing too. That did expire at the end of the year, and it, like I said, it is voluntary. I guess I would just, and I'm sure everybody's familiar with it, be mindful that New York State had their own kind of sick leave, their own COVID leave, and their own, you know, effective September 30th, their own paid health that starts accruing. So I would just make sure, you know, if you've decided, great, it's the end of the year, I don't have to provide that anymore. There is a New York State law that says you do. So the rates and the amount of pay is different, but just make sure, you know, that you're keeping tabs on that as well.
Yeah, and if I, Connie, before we get to the next question, you know, that's just a good point to make. States are just strapped for funds. And, you know, while the federal government makes these rules and wants to help the population, states, not so much all the time. So my point is, based on the state you're working in, make sure you're familiar whether they're following these federal laws, not following them, or having laws of their own that are similar or totally different.
And just to expand a little bit on that, with the COVID paid leave for New York, the carriers, that's who are paying the claims. It doesn't involve a tax credit. However, with that said, if you did offer the federal leave, the carrier wants to know that because that kind of is primary in making the payment to the employee. And then after that, the COVID would come in. So there's a couple of things in regards to that. Those are great points, so I appreciate it. That at this time, just for the essence of time, we're going to conclude the the webinar. I'd like to thank everyone for their time today and being on, who were able to listen to the presentation. We'd like to extend our appreciation to Bowers and Company, Dave and Rich. That was really good information. If anyone does have any additional questions, they can email me and we will forward them on to Bowers and Company, Dave or Rich, to be able to help you out with that. Again, thank you very much, and thank you, Dave and Rich. It was very well presented.
Thank you, Con. Thank you.
Have a great day, everyone. Be safe.